Hi everyone, we are Group 5 from JBA2515A and today we'll be presenting about case study. Before we move further to our content, let me introduce you to our group members, which is the first one we have Mohd, Shamil, Adam, Amir Syakir and myself Faridatul. To the first case study, which is
Case study 1. Danish is an investor who owns 200 shares of LMN Ltd, which he purchased at 30 ringgit per share. His stock is currently trading at 32 ringgit in the market. Danish believes that over the next month, the stock price will remain stable or increase slightly, but he does not expect a significant price rise. To generate additional income from his existing investment, he decided to implement a covered call option strategy. Option contract details: type of option is call option. Strike price is 35 ringgit. Premium received is 1 ringgit 50 cent per share. Contract size 100 shares. Number of contracts sold is 2.
Let's take a look at the case study 1, question 1. Identify and briefly explain the option strategy used by Danish. So, there are two types of position in covered call option, which are long position in the underlying stock and short position in a call option. Okay, based on our answer shown on the slide, the option strategy used by Danish is a covered call strategy. A covered call strategy occurs when an investor already owns an underlying asset and sells call option on that asset. By using this strategy, Danish earns premium income upfront while still holding the asset. However, if the market prices rises above the strike price, he is obligated to sell the asset at that price, which limits his maximum profit. So, this covered call strategy is suitable when an investor expects the price of underlying asset to remain stable or increase slightly. Danish uses this strategy to generate additional income through premiums while reducing overall risk. Although his upside potential is capped, the premium received helps improve returns and provide some protections if the market does not move significantly. Let's take a look at question 2, which is calculate the total premium income received from selling the call options. So our answer is 1.50 ringgit times 200 shares equals to 300 ringgit. Based on our answer, the total premium income is calculated by multiplying the premium per options and the number of contracts sold. We calculate it this way because options premiums are quoted per unit and each contract represents a fixed number of underlying units. So, this calculation method is important because it reflects the actual cash income received by Danish, and by multiplying all components together, we ensure that the total premium income account for the full exposure for the option contract. The premium is received immediately and serve as guaranteed income, regardless of whether the options is later exercised or expired.
My name is Cik Muhammad Adam bin Mansor. I will continue to the question 3. Determine the break-even price of the strategy. So the formula is break-even equal to long stock price minus premium received. The calculation is 30 ringgit minus 1.50 cents equal to 28.50 cents. Then we go to the question 4. Calculate the maximum profit possible and explain where it occurs. So the formula is maximum profit equal to EP minus BP plus premium. So the calculation is 35 ringgit minus 30 ringgit plus 1 ringgit 50 cents equal to 6.50 cents. So the total maximum profit 6.50 cents times to 200 shares equal to 1,300. So this happen when price is equal to 35 ringgit and higher. Next, we jump to the question 5. What is the maximum possible loss for Danish? For the formula is long stock price minus premium. The calculation is 30 ringgit minus 1 ringgit 50 cents equal to 28.50 cents. So the total maximum loss 28.50 cents times to 200 shares equal to 5,700.
I'm Azmahathir Bin Asman, and now I will explain the profit or loss at expression for a long stock and a share call option at a different stock price. So we go to the first. When the stock price is Rm 25 ringgit, the long stock made a loss of 5 ringgit, while the share call give a profit of 1 ringgit and 50 cent. Next, at 28 ringgit, the long stock has still a loss of Rm 2 ringgit, and the share call still earn 1 ringgit and 50 cent. At the break-even price, 28.50 cent, the long stock loss is reduced to 1 ringgit and 50 cent, while the share call continue to give 1 ringgit and 50 cent profit. When the stock price increased to 33 ringgit, the long stock now made a profit of 3 ringgit, and the share call remained at 1 ringgit and 50 cent profit. At 35 ringgit, the long stock profit increased to 5%, while the share call still earned Rm 1 and 50 cent. Finally, when the stock price rise to 38 ringgit, the long stock made the highest profit of 8 ringgit, but the share call result in a loss of 1 ringgit and 50 cent. In conclusion, the long stock benefit more when the price rise, while the share call has limited profit and can face losses at higher price. So we go to the next question, which is question 7. Next, we are going to the next question, which is question 7. Draw and label the payoff diagram for the covered call strategy. So now I will explain the payoff diagram for a covered call strategy. First, a covered call is created by buying one stock and selling one call option of the same stock. This strategy is usually used when we expect the stock price to move slightly upward or stay stable. On this diagram, the horizontal axis shows the market price, while the vertical axis shows profit and loss in Ringgit Malaysia. The green line represents the long stock. As the market price increases, the profit from the stock also increases in a straight line. The red line shows the short call option. It earns a fixed premium at first, but after the strike price, the profit decreases as a stock price rises. The yellow line represents the covered call payoff, which is the combination of the long stock and the short call. At the lower price, the covered call still faces a loss, but the loss is reduced by the call premium received. At the break-even point, around 28.50 ringgit, the strategy start to make profit. As the price increase, the profit rise until it reach the maximum profit, around 6.50 ringgit. After this point, the profit becomes flat because gains from the stock are offset by losses from the short call. In conclusion, the covered call strategy gives limited profit, lower risk, and suitable for investors who expect moderate price movement. So we're going to the next question, which is question 8. So we are going to the last part of the question 1, which is question 8. Based on your analysis, comment on whether this strategy is suitable for Danish market expectation. So, based on the analysis, the covered call strategy is suitable for Danish market expectation. First, this strategy generates income through the call premium. Even if the stock price does not increase too much, Danish can still earn extra income from selling the call option. Second, the covered call provides limited downside protection. The premium received help to reduce loss if the stock price falls slightly. Third, this strategy keeps the upside potential. This means the profit is limited if the stock price rises sharply. However, this is acceptable because Danish does not expect a big rally in the market. So for the overall, since Danish expect the market to be stable or increase moderately, The covered call strategy fits well with his expectation. It offers steady income, control risk, and reasonable returns. So that's all from me. Thank you.
Assalamualaikum and hi. My name is Muhammad Shamil Ilham bin Rozihan. And my ID number is 2023 278 048. And I will explain the case study 2. From case study 2, the question is a call option has the following characteristic. The strike price or exercise price K is RM30. The current stock price is S0 is RM35.5. Then the time to expiration is 3 months or also 3 steps. The stock volatility is plus minus 10% for every month or per month. And then the upward probability or P is 70%. And then if the upward 70%, so the downward is 30%, right? So the risk-free interest rate is 2% for every month or per month, and then the stock price move monthly. Well, the question is calculate the call option value using the binomial option pricing model. And I will explain to you on how to calculate this question later. From case study 2, the question is a call option has the following characteristic. The strike price or exercise price K is RM30. The current stock price is S0 is RM35.5. Then the time to expiration is 3 months or also 3 steps. The stock volatility is plus minus 10% for every month or per month. And then the upward probability or P is 70%. And then if the upward 70%, so the downward is 30%, right? So the risk-free interest rate is 2% for every month or per month, and then the stock price move monthly. Well, the question is calculate the call option value using the binomial option pricing model. And I will explain to you on how to calculate this question
Assalamualaikum
later.
warahmatullahi wabarakatuh. My name is Amir Syakir Bin Ali, and I will continue on answering of the case study 2 from what my friend Muhammad Shamil Ilham have said before, that we need to extract the the data from the question. And so after what we have done before, and so now what we need to do is we need to do the binomial diagram. So what basically we need to do for the binomial diagram? First of all, in this slide, you can see that we have the first box that is for 35.50 ringgit. That is the current stock price. And from that, we know that what we have the probability that the probability for the up that is 0.7, and probability for down that is 0.3. So after that, we need to find the for the path one, which is the how we find the 39 ringgit and 5 cents. What basically we how we calculate that is from the first previous box, that is the current stock price. we need to because in the question it state that the uh, the the price volatility will increase or less for 10%. So from this we know that for if the price is goes up, the price will the price before need to multiply with 1.1. So if the price goes down, so the previous price need to multiply with 0.9. So after that we will get the path 1, and we will continue on do the same thing for the path 2 and the path 3. So after we get all this basically these 3 paths, and last for the last path we need to calculate the payoff, call option payoff. So is that is state and in this question that this call option. So what basically call option is uh, s minus x. So we need to remember if for the call option is s minus x. So for the first payoff, for the first of the box in the path 3 is s minus with x. So you can see that when you in this question they state that x is equal to the 30 ringgit. So you can find for each of the for the path last path, which is path 3, and you will get the answer for this one. So after we get all this of the payoff, call option payoff, and we can see that for the last box, bottom one, you can see that we'll get the negative sign of the call option payoff. And basically when we find the any payoff that have been given our positive, so it will we need to convert it to the zero. But basically if we find the payoff is negative, so the option payoff is we need, equal to 0. So and after that we need to find the terminal value before. So for the terminal value is as you can see for the first the the upper upper box is, you can see that basically you need to use the payoff and multiply with up probability of up, probability of up, and probability of up 3 times. So and for the second one is up up down, but it happened 3 times. So it's same calculation, but you just need to multiply by 3 because it's happened 3 times. And for the third box is for up, basically this is up down down, and same, it's happened 3 times. So after you get all this, you will get the answer for the terminal. Now I'll continue on the last step to answer this question. So what basically this question want us to find is current value of call option. So for the calculation formula of this current value of call option, well basically is you plus all the terminal value that you get before and divide it with the discount factor. So for the discount factor, you need to use this formula, basically this, and from that you will get the answer that is for the terminal value. You get with 10.05 and divide with discount factor, which is 1.0612, and from when you plus the when you click the calculator, you will get the answer. Last answer is RM 9.47 for the current value of the call option. So that's all. So this is how you answer. So that's all from us. I hope you guys like our video. and thank you for the listening.